Ryan Pappas here from Mortgage Choice, and today I want to do a quick video on why people are refinancing in the current market. A lot of people think refinancing is simply to achieve a better interest rate. Whilst it's an important factor, it's not the only reason people are refinancing. So today, join me for a good 5 minutes on another reason why people are refinancing.
What is refinancing? Refinancing simply means replacing your existing home loan with a new one. That might be with a different lender, or it could be restructuring your loan with your current bank. People do it for all sorts of reasons. Getting a better rate, accessing equity, consolidating debt, or changing the structure of their loan to better suit where they're at financially. In a higher rate environment, one strategy is particularly becoming more and more popular, and that's using a refinance to extend your loan term and free up monthly cash flow. It doesn't get talked about enough, so let's walk through how it works. The strategy, extending your loan term. Here is a real-world example to bring this to life. Say you took out a $750,000 loan 5 years ago. You've paid it down to $700,000 and you've got 25 years left on the loan. Your lender is offering you a rate of 6% per annum. If you keep the 25-year loan term, your repayments are around $4,500 per month. But if you refinance and reset that loan back to 30 years, your repayments could drop to around $4,200 per month. That's $300 a month back in your pocket. Now, I want to be upfront here. Extending your loan term does mean you could pay more interest over the life of the loan. So this isn't a strategy that suits everyone. If you're close to paying your loan off, or you've got aggressive debt reduction goals, this probably isn't right for you. But for the right person, that's a $300 a month saving, and it can be genuinely powerful. There's also something worth understanding about how most lenders calculate your repayments. When rates go up, most lenders calculate your monthly repayment based on the original loan amount over the original loan term at the new higher interest rate. So even though you've been paying your loan down, your repayments go up as if you haven't made a dent. That's part of why so many people are feeling the squeeze right now, and why extending the term can provide some breathing room. However, this is not for everyone. So what can you do with the extra cash flow? This is where it gets interesting. Some people put it straight into their offset account, which effectively reduces the interest they're paying anyway. Others use it to hold an investment property or to build a buffer when life gets expensive. Is this right for you? The honest answer is it depends on your situation. And extending a loan term to free up cash flow can make a lot of sense in a higher interest rate environment, or when you're trying to get an investment strategy off the ground. But it needs to fit your broader financial goals. And ideally, you want to be working through this with a mortgage broker and a financial planner. What we can help you with is the loan structure side of things, looking at whether refinancing makes sense, what your options are, and how to set up things so your loan is actually working for you. Before I wrap things up, I just want to be clear that everything I've covered today is general information only. It doesn't take into account your personal circumstances. Strategies like debt recycling and structuring your loan can have real financial implications. So please make sure you speak with a qualified financial planner before making any decision. Your own situation is unique, and it's worth getting advice that's specific to you. Now, the key takeaway. Refinancing isn't just about the rate. Sometimes the bigger win is the cash flow and what you do with it. If you want to talk through whether this kind of strategy suits your situation, reach out and we can walk you through the numbers together.